Welcome to the Pro Ticker Deep Dive. So we're diving into a real head-scratcher in the markets today. You know, for ages, the story's been all about tech's unstoppable growth. Maybe value investing is, well, dead.
Or at least on life support, right?
Exactly. But now, it's November 2025. The Fed's actually started cutting rates. This should be the textbook moment, shouldn't it? Policy easing kicks in, and boom, money floods into those cheaper value stocks.
It really should. But it just hasn't happened. That big rotation everyone was predicting, it's basically stalled.
Yeah.
Instead, what we're seeing is this really deep divide opening up between growth and value. The valuation gap is huge, possibly one of the biggest we've ever tracked. The market's just not playing by the old rules.
And that's exactly what we want to unpack in this deep dive. We're going to sift through the data, try to figure out why that traditional link Fed eases value rallies seems broken this time around.
Mm-hmm. And what's keeping those important long-term interest rates so high?
Right. And ultimately, is this crazy level of market concentration, just a few big names driving everything, actually sustainable?
It's fascinating, isn't it? It's like market psychology is just clashing head-on with the economic signals. We need to look not just at what the Fed did, but how investors, how the bond market read those moves.
Okay, let's start with the hard numbers then. Let's really define how stark this divide is. Looking at the year-to-date figures through November 2025, this really sets the scene.
It does.
So growth stocks, think big tech. Communication services, they've absolutely flown, up 24.8% year-to-date.
Yeah, a huge number. But that 24.8%, it masks a lot of what's not working. You look at value stocks, they've recovered a bit, sure, up maybe 11% year-to-date.
Which isn't terrible in isolation.
No, but they're lagging growth by, what, over 1,300 basis points? That's a massive performance gap.
Yeah.
And the wording thing, that gap has actually gotten wider since the Fed started cutting.
Wow, so the rate cuts almost made it worse for value, relatively speaking.
In a way, yeah. The market just doubled down on growth.
And the valuations really tell that story, don't they? The S&P 500's forward price-to-earnings ratio,
Yeah.
it's above 24 now.
Yeah, sitting just north of 24 times forward earnings.
Yeah.
Historically, the average is more like 18, maybe 19.
So significantly higher. By some measures, this is one of the priciest markets we've seen in a while.
It is, but it's very lopsided. You got those mega cap growth darlings trading at, 24, 30, even 35 times earnings. They're getting this huge premium.
Mm-hmm.
Meanwhile, the actual genuine value stocks, the cheaper cyclical businesses, they're stuck trading at really big discounts compared to their history, just languishing.
Which brings us to the big question for you listening right now. Okay,
Yeah.
Everyone kind of agrees the market looks expensive overall. Does that classic advice, buy when others are fearful, buy that cheap value, still hold water?
Right.
Or has something fundamentally changed? Is this concentration risk, the sheer dominance of the Magnificent Seven, NVIDIA, Apple, Microsoft, Alphabet, Amazon, Tesla, Meta, just rewriting the playbook?
It's the core question. And to get closer to an answer, we have to look at the macro picture.
Yeah.
Specifically what the Fed did. Remember, they were pretty tough well into early 2025. Rates got over 5.5%.
Super hawkish. But then things started to shift mid-year, didn't they? Inflation, which was terrifyingly high.
That 9.1% peak,
It really started to cool off, drop down into that, 2.4 to 3.0% range.
pretty significant moderation. And at the same time, the job market, while still strong, softened just a touch. Unemployment ticked up a bit from its low, maybe towards 4.2% by the fall.
Okay, so the data gave the Fed some room to maneuver.
Exactly. The window opened, so they delivered. 2 cuts, 25 basis points each, one in September, another in October.
Right.
That brought the Fed funds target range down to 3.75, 4.0%.
Right.
So officially, the easing cycle was underway.
And this seems to be the absolute crux of it. Those cuts hit the short end of the interest rate curve. Short-term borrowing costs came down, yet the 10-year Treasury yield, the really important one for long-term financing and valuations, it just refused to budge much. It stuck up there near 4.0, maybe 4.5%.
Stubbornly high. And that's the heart of the paradox. If the long-term cost of capital doesn't fall significantly, that traditional value rally just doesn't get the fuel it needs.
So why? Why is the long end staying so high when the Fed is clearly signaling lower rates?
Well, there are really 3 main things going on as the market sees it. First, these initial cuts. The market kind of shrugged them off as just insurance cuts.
Like just a little tweak, not a major change in direction.
Precisely. The expectations for a really deep, aggressive cutting cycle just aren't there yet. The market thinks the Fed might pause again. Second, and this is a big one, there's a lot of anxiety about U.S. fiscal policy. Global debt is massive, heading towards $100 trillion.
Wow.
So bond investors are demanding a higher premium, more yield to hold on to long-term U.S. debt because there's just so much of it,
Yeah.
and more potentially coming. That naturally puts upward pressure on long-term rates.
Okay, so supply concerns. But wait, if the Fed's actually cutting now, shouldn't that central bank action kind of override worries about government debt, at least in the near term? Why is the bond market seemingly ignoring the Fed's lead here?
Because the market knows the Fed really only has direct control over the very short end of the curve. Long-term rates. They're driven by a whole mix of things. Future inflation expectations, global capital flows, and, supply and demand for bonds.
Right.
So if those long-term borrowing costs stay elevated, it puts a sort of glass ceiling on value stocks. Think about it. Banks, industrials, utilities, they often rely more on stable long-term debt financing. Or their cash flows stretch way out into the future, and those get discounted more heavily when long rates are high.
So the market's basically saying, nice cuts, Fed, but policy isn't really easy yet. It's still kind of restrictive because the long end hasn't moved.
That's a great way to put it. Modestly restrictive, not genuinely accommodative. Not yet, anyway.
Okay, so if the macro picture isn't lifting value, where is the money going? Let's talk about that concentration again, the Magnificent Seven. It's just incredible. They make up, what, around 30% of the S&P 500 now?
Roughly 30% of the market cap, yeah. And they're basically responsible for almost all the index gains this year. It's quite extreme.
How do people justify paying such high prices for them?
Well, the bulls have a story, right? They point to the earnings growth. That Mag 7 group is expected to grow earnings around 15% annually. Compare that to maybe 10% for the entire rest of the S&P 500.
It's just significantly faster growth.
Yeah, and investors are clearly willing to pay a massive premium for that perceived certainty, that growth, and especially anything tied to AI. You see NVIDIA trading at 40 times earnings, Broadcom even higher at 54 times. It's all about buying that AI exposure.
Okay, so that's one pull, expensive AI-driven growth. Now let's swing to the other extreme small caps, the Russell 2000 index. Traditionally, that's where you find deep value, right?
Often, yes.
But small caps overall are only up about 10% this year, which is weird because the forecast for earnings growth for the whole segment is actually huge, like 26.5% projected growth for 2025.
It is strange. And this is where the story gets even more bizarre, moving away from fundamentals towards, well, speculation.
How so?
Get this. Within that Russell 2000 index, something like 43% of the companies,
Yeah.
they don't actually have any positive earnings. They're losing money.
Nearly half. Wow.
Yeah. And guess which small caps have performed the best this year? It's those unprofitable ones. They've rocketed up 55% year to date on average.
Hey, the money-losing companies are up 55%.
While the profitable small caps, the ones actually making money, the ones you'd think value investors would like, they're only up about 8%.
That is kind of wild. So the money is either chasing the biggest, most profitable AI giants, or it's chasing completely speculative, unprofitable small companies.
Pretty much. There's very little interest, very little capital going into those stable, profitable, reasonably priced companies caught in the middle. The traditional value plays.
Okay, this really helps crystallize things. So let's tie it all together. What are the, say, 3 main reasons why those Fed rate cuts completely failed to spark that usual value rally?
Right, let's synthesize. Reason number 1. The policy shift itself was just too timid. Those 50 basis points of cuts, everyone saw them coming, they were priced in. The market read it as the Fed just applying a little insurance against a slowdown, not slamming the accelerator for stimulus. Policy still feels restrictive.
Okay, too modest. What's reason 2?
Reason 2. Those sticky long-term rates we talked about, they actively hurt value sectors. If the 10-year yield stays high, think about banks, their net interest margins get squeezed.
Right, hurts their profit.
Exactly. Or think about dividend stocks or things like real estate investment trusts, REITs. They need lower long-term rates, lower discount rates to make their future income streams look attractive. High bond yields kill that appeal. And these are sectors where value stocks tend to cluster.
Makes sense. And the third reason?
Third, and maybe underappreciated, is policy uncertainty. Specifically, worries about potential new tariffs, maybe broad 10% levies on imports.
Trade wars again?
Could be. Even the threat creates drag. Historically, a 1% rise in tariffs can add about 0.1% to annual inflation. So that threat helps keep inflation expectations and thus long-term yields a bit higher.
And it probably causes a flight to safety too, right?
Precisely. Capital flows towards the biggest, most globally diversified companies, the Mag 7 again, because they're seen as relatively more insulated from purely domestic tariff issues compared to smaller, more cyclical companies.
You can really see this playing out sector by sector. Financials just seem stuck, even though their earnings aren't bad. They're waiting for that yield curve to help them.
hmm And energy stocks that are being priced like oil is stuck at $60 a barrel forever, even though they offer a natural hedge if inflation proves sticky.
Right. And those REITs you mentioned, still trading way below what their actual property assets are worth.
Yeah, substantial discounts. Fundamentally, many look okay, but the market won't unlock that value until it's convinced long-term borrowing costs are definitively heading lower. It's just an environment that really tests your patience if you're a value investor.
Okay, so that sets up the dilemma perfectly. Let's lay out the bullish case for value. Despite all this frustration, what's the argument for buying these neglected stocks now?
Well, the number one argument is just the sheer valuation gap. It's genuinely historic. You've got small cap value trading at what, 16.5 times forward earnings?
Yeah, you mentioned that.
And yet that same segment is projected to grow earnings by over 26%.
Hmm.
That disconnect, that risk-reward potential, looks incredibly attractive on paper.
Plus, history's on your side eventually, maybe, mean reversion.
Exactly. History strongly suggests that after these long periods where growth stocks dominate, buying the cheap, out-of-favor value stocks eventually leads to really strong returns over the next, say, 5 to 10 years. And if the economy does manage a soft landing, avoids a deep recession, these cyclical value names have enormous catch-up potential.
Okay, that's the bull case. Compelling, if you have patience. But the bearish case, the immediate worries, they're pretty potent too, aren't they?
They definitely are, and you have to be aware of them. The biggest, most obvious one is that concentration risk we keep hitting on.
The Mag 7 dominance.
Right. With so much market value tied up in just a handful of names, the top 50 stocks are nearly 70% of the market value now. What happens if that AI narrative falters?
Yeah, like if regulators step in or demand doesn't keep up with the hype.
Exactly. If that story cracks, the unwinding could be incredibly fast and painful simply because everyone's crowded into the same stocks.
Okay, concentration risk is number one. What else?
Then there's the scenario that might be the most frustrating for value investors, the grinding bear market. This isn't a crash. It's where those long-term rates just stay stubbornly high, maybe due to ongoing debt concerns.
So value stocks don't collapse.
No, they just go sideways. For years, they look cheap, they stay cheap, but they don't deliver any capital appreciation. It's sort of death by 1,000 cuts for your portfolio, even if you're technically right on valuation.
Ugh, that sounds painful. And there's still a risk the Fed could backtrack, right?
Absolutely. Fed reversal risk. If those potential tariffs or some other shock push inflation back up unexpectedly, the Fed might have to hit pause on cutting rates.
Or worse.
Or worse, they might even have to resume hiking rates sometime in 2026. That scenario would likely hit both the expensive growth stocks and the rate-sensitive cyclical stocks pretty hard, at least initially.
So it really boils down to this uncomfortable situation where both sides seem right. Growth is historically expensive and concentrated. Value is historically cheap and neglected.
They're both true at the same time, which means timing, or maybe just your time horizon, is absolutely everything right now.
What's the final thought for listeners to chew on then?
I think the key thing to remember is that this rate-cutting cycle, it's really only just begun. We've only had 50 basis points. The reason we're stuck in this weird dynamic where value isn't responding is because there's just no clarity yet on the total amount of easing or the final destination for rates.
So what the Fed signals next month in December and into 2026, that's way more important than the cuts we've already seen.
Far more important for long-term rates, yes. That's what the bond market and ultimately the value stocks are waiting for, a clearer signal that policy is becoming truly accommodative and that long-term rates have peaked for good.
Right. So for value investors, it really comes down to having serious conviction and just mandatory patience, it seems. The potential reward is there on paper, but the catalyst, that certainty, is missing. And for shorter-term traders, it means being super watchful of those key market levels, like, say, 6,700 on the S&P 500, as potential support. It's really that cloud of uncertainty around tariffs, inflation, where rates ultimately settle, that's acting like a dam, holding back that capital rotation for now.
Well said.
See you all in the next Pro Ticker Deep Dive.